All right, so let's start mergers and acquisitions. These mergers and acquisitions, business groups are one of my favorite chapters because my work is also on these topics. So my research is on mergers and acquisitions and business groups. So I find them really interesting. Let me share my screen. So basically, we will cover several points. Why firms do mergers and acquisitions, and we already have some uh, you know spilling or some idea from our previous chapter which spills over here to this chapter as well, that we saw diversification, right? So the logic is kind of similar, that why would firms acquire or merge with another firm to diversify, right? So we'll see what are the rationales behind M&As and what problems do firms face when they do so, right? So M&As are very popular all over the world, and they are very common in markets. What could be some of the reasons why M&As happen? Uh, because firms want to gain market power, right? So if they do horizontal M&As, that is, they acquire one of their rivals, then their size will increase and their competition will reduce. So if they acquire one rival, then one firm less in the competition, right? So they can now charge more price. Market power is charging more price or cutting down your costs. So they can do both, right? Due to pooling of negotiation power or um, charging more because there are less options available for customers now. And they can also do M&As to spread their risk, like spreading the risk could be in several ways, like entering new business line, new product segment, or new geographic segments, right? Or due to industry and regulatory challenges, which we saw in the previous chapter as well, right? This tax laws, antitrust regulations, and all those things, right? And so M&As have been increasing, which is very ironical and funny because M&As mostly fail. So in two-thirds of the acquisitions, also no, where's the statistics? Probably in some of the next slides. So M&As are generally not very successful, right, in the long run, but it's still they're very popular. Still, they keep happening, and their volume is only increasing every year. And the returns are uncertain. In most of the acquisitions, acquiring firms, the stock price falls after the transaction is announced. While acquired firms, of course, they have above average returns. So it's good for the firms that are acquired, but not necessarily good for the acquiring firms. And why are these problems in M&As? So one of the major problems in M&As is how to evaluate or quantify the target firm. So, you do you follow the news about this? What is this? Warner Brothers being acquired by Netflix and Paramount, right? You must have read the news. So, I think Paramount quoted like 108 billion dollars, if I remember correctly, $108 billion for Warner Brothers, while I think Netflix quoted something like 70 or $80 billion. So you see such huge difference, almost $25 billion difference that is being quoted by both the firms, right? So the problem is how to know what is the right value of the target firm. What is the price that we should quote? And I do an activity in fall and spring semesters. I do an activity in this lecture, M&A lecture, that I bring I mean, because of in-person classes, I bring a jar, a transparent jar, small jar, in which there are several coins. Several coins, by several I mean like 30, 40 coins. Uh, some are penny, some are 10 cents, some are quarter, some are 50 cents, some are different denomination coins I bring, and then I circulate the jar in my whole class, and I ask each student to write an estimate of the value of the total coins that they feel, that they think is in the jar. So you might have done guesstimate activities for interviews. I don't know. We used to do when we were in undergrad. Companies used to ask guesstimate questions in interviews. So I get different answers. I get from like $5 to $100, $150. I get a long range of answers from students. The actual the actual value of those coins is like $25.50 something, right? So that is a problem we face in real life as well, that we have no idea what price should we give for the firm, because we might be overestimating the value of the target firm, right? That is what is the meaning of this word premium. Justify the premium to purchase the target firm. Because companies are ready to pay premium for the there are several ways you can do that. Uh, how so suppose if you are a firm, what metrics can you think of evaluating the target firm? What metrics come to your mind when you think such an activity, that you have to buy a firm, you have to purchase a firm?
Their asset, their equity,
So total assets, total equity, yes, great.
EBITDA,
Hmm.
EBITDA, earnings
EBITDA.
before, yeah,
Okay.
Goodwill.
Mm-hmm. What is that?
Goodwill. Not sure if that is.
Goodwill. How will you evaluate goodwill? How will you quantify that? That is very abstract thing, right?
Mm.
Market capitalization as well, right? Market capitalization. In that, actually kind of quantifies goodwill, because what market thinks about the firm, right? The firm is really popular, it has a lot of goodwill, then it will probably have higher market capitalization, right? So yeah, all these methods that you can use, but that is not always the most accurate method, right? It's not that, oh, whatever the market capitalization is, or whatever the total equity or total assets are, I will just give that much amount. That's not how it works. First of all, the target firm expects higher than that. But again, the question rises, how much higher, right? And that is where the consultant firms step in, Accenture Strategy, all these firms. What is their job? They do these things, right? That is what they do in strategy, right? They make strategies for firm. So if I am an M&A, if not, if I want to pursue an M&A, I will go to a strategy firm or investment bank. I will ask them to do that task for me, to prepare a report, uh, how to go about the M&A, right? That is what those consultants do. And so, yeah, that is the problem these firms face. Determining the worth of a target firm is difficult. What is the difference between merger and acquisition? So, as the name signifies, merger is generally when you come together on a co-equal basis. And while not true in every case, but a very common way of identifying a merger is when you when both the firms come together, you have a new name and new ticker symbol. You understand ticker symbol, right? On the stock exchange. So, like for Apple, it is APPL, right? So the symbol that you have on stock exchange, if you have a new ticker symbol and you have a new name, then uh, it would be a merger. And generally, like two firms join their name, right? So, like Suzuki and Maruti in India, when they merged, they came together. Their new name is Maruti Suzuki. So they will just add both their names uh, for the new firm. Now, the problem with merger is again that how do you fuse the disparate corporate culture? So, two firms have come together to form a new firm. Who will be the new CEO? Who will be the new CTO? Who will, these are the problems they face. Besides different corporate cultures, different work cultures, they also face the management problems, that who will have which post in the new firm, who will have how much power in the new firm. That is very difficult to agree upon. An acquisition is generally when there is one senior firm and one junior firm, that is one acquiring firm and one target firm, and target firm gets subsumed in the acquiring firm, right? And again, this also faces the same problem. I've seen so many examples where when a firm got acquired, most of their staff quit the company because they were not happy with the new company. And takeover is when hostile acquisition, unfriendly hostile acquisition. That is, the target firm never asked to be acquired, but still the acquiring firm is consistently bidding for it and wants to acquire it. And there are many ways through which these target firms can, you know, prevent their takeovers. What are the ways? So, the first is how the firms carry out these takeovers. So, one is that you just bid publicly. You just ask, the shareholders to sell their shares at a premium price. You start buying their shares and you acquire majority stake, or not necessarily majority, but significant stake. Even 10% or 20% stake is enough to give you some controlling rights, or, some position in the board of directors. Then proxy fight. Proxy fight is when you try to convince the shareholders to vote out the existing board of directors in favor of a new board, which the acquiring firm will send their people in the existing, in the board of directors, their representatives, and then they will take over the company. Then creeping takeover or open market, they are both kind of, you know, similar kind of things. Is when you start buying the shares slowly. So tender offer is when you buy a significant number of shares instantly, like 20%, 25% shares. So that may sometimes kick in regulatory requirements. But if you want to slowly acquire a lot of shares, evading the attention of the target firm, then that would be creeping takeover. That is, you accumulate shares, creeping takeover and open market purchase. Open market purchase is just a, action of doing creeping takeover. Is when you accumulate shares without alerting the target company's management. And the fifth and the, you know, most simple way of acquiring is that you file a lawsuit against the target company if it believes that the board is not acting in the best interest. So, do you remember from the Southwest presentation that I showed you the slides that a hedge fund called Elliott Management had acquired 10% stakes in Southwest because it felt that the Southwest administration is not doing a good job. So they acquired 10% shares and demanded some changes in the management of Southwest. Right? It was in the news, in the last slides when I showed you the news article. Right? So that is an example at how these, hedge funds or acquiring firms can demand changes and you know try to do hostile takeovers because they feel that the firm would the firm is not doing a great job and the firm would be better under their administration. And how can firms prevent takeover? One is that you make your stock less attractive to the acquirer by allowing existing shareholders to buy additional shares, which means now the acquiring firm will have to buy more shares at a higher price, so the acquisition becomes expensive, right? Or you can try for a higher bid, like this thing, this Warner Brothers and all. Paramount gave a higher bid, though Warner Brothers refused 2 days ago. But you can always look for a more favorable company, right? Which might pay you higher price or more favorable terms, like we would keep the management as it is. We will not fire anyone from the acquired firm. We will keep all the employees. So those kind of terms, favorable terms, right? So you can always try looking for a white knight. Then golden parachute. Golden parachute is if some you can write in the regulation, company constitution that if a firm tries to take you over, then the executives, the top executives, CEO, CMO, CTO, and all, they will get very lucrative packages. You know, I don't know, some very high amount of money or something like that. So again, you are just trying to make the acquisition costly for the acquiring company. And similarly, you can also write down in the uh, company constitution that uh, there would be a staggered board of directors. That is, every year, only few positions would be available for new people. So they would not be able to change the board of directors that easily, and which would mean that they would not get the desired amount of control in the acquired firm. Then there is Pac-Man defense. Have you guys played Pac-Man? No? Maybe during childhood. No, Pac-Man defense is when the target companies, turning the table around. That target companies start trying to acquire the acquiring company. And of course, the most simple way is regulatory and legal, that you can go to regulatory authorities and say that this takeover is not good for our firm, it's not in the best interest of shareholders, or it violates antitrust laws. Right? So these are the ways. There's many other ways as well. We will see one or two more ways in the next chapters. So this is how firms can prevent takeover. And these exchanges, so these, going back and forth, that target firm is talks to acquiring firm that we are not happy with your bid. Then they say, give us a few days, we'll think about it. Then the acquiring firm comes again, changes its bids, changes its terms and conditions. Then they again say, we'll think about it. These exchanges, they keep taking place sometimes for years. Sometimes the acquisition does not get completed for several years, and even after those several years, it may happen that it might get aborted and it might never complete. So this is a very long and complex process. So what are different reasons for acquisition? Well, the most common reason is to increase market power, right? We saw in the previous chapter as well. You want to increase the size of the firm, you want more resources and capabilities, you want higher share of the market, right? So this is the most common, most intuitive logic for acquisitions. But this also involves antitrust legislation, and these legislations are very powerful in several countries, especially the better institutional environment of a country is, the stricter antitrust legislations would be. Like, for example, suppose if tomorrow Amazon and Walmart decide to merge, what would happen to the market? Completely decimation. Like, rivals would be completely decimated. There's no way any other firm would be able to survive, because if the two, you know, like the two dinosaurs or the two dragons of the market decide to merge, then others have no chance, right? And I guess last year there was something like this. I think Frontier and JetBlue were trying to merge, but the authorities refused. They say that it goes against antitrust laws and they did not allow the merger. Because if there are less options in the market, it's detrimental to consumers, because then they would be able to charge higher prices. There would be, consumers would be at a loss. It could result in monopoly, duopoly kind of things, and there would be slower innovations because they don't have strong competition now. So slower innovations, higher prices, and more inefficiency, right? Mm. Then research has also shown that vertical acquisitions are generally very successful, and they give a lot of value to the firms. Vertical acquisition is if you are acquiring or merging with a firm in the supply chain, either upward integration or downward integration. with either your suppliers or distributors, right? So they are generally very beneficial for the firms. And related acquisition could be both vertical as well as horizontal, but generally used in the sense of you know vertical acquisitions or complementary acquisitions, like a phone firm acquiring a video game firm or app firm, something that complements your abilities, so that way synergy can be produced. Then second reason for M&As is overcoming entry barriers. So if you want to enter an industry which has high entry barrier, say Walmart wants to enter airline industry, it requires a lot of capital, or it requires a lot of differentiation, then you know rather than starting from scratch, so Walmart will have to start a new department for airline. If it does not want to acquire a firm, if it wants to do on its own, then it will have to start a department from scratch. It will have to hire engineers, it will have to develop those capabilities. So rather than doing that, they would think that let's just acquire a firm and enter the market, right? Or, for example, if you might remember when I explained this race to the bottom thing, uh, Walmart acquired Flipkart in India, right? There were two firms, Amazon and Flipkart, and later Walmart acquired Flipkart in India, right? So, because it's a big market, important market uh, uh, for the firm, like Indian market is very big, but the barrier to entry is strong because it has to compete with Amazon there. So it thought that it's better to acquire a local firm which is doing well and then compete rather than starting from scratch. So that is why cross-border acquisitions are very common, and historically it was mostly it were mostly North American and European companies which were acquirers, but nowadays even companies from other parts of the world are very active in cross-border acquisitions, and especially firms from Asia. They especially Chinese, Korean, Indian firms. These firms are very actively engaging in acquiring American and European firms for technology. So you would find a lot of Chinese and Indian firms acquiring startups or firms in Silicon Valley, or these pharmaceutical firms in Boston and New Jersey, you know. So that is becoming more and more common nowadays because they want to compete globally, and they feel that if they're lagging in technology, then it's better to acquire some a good firm in California or some other place, some other good firm here in the West. Just a second. What are the risks with cross-border acquisitions? I mean, risks are these are quite intuitive logics that if you are going to a new legal environment, a new different culture, Of course, there are a lot of risks attached. Like for example, firms have faced problem with Chinese firms that if, especially if the Chinese firm has CCP's involvement or CCP stakes in it, then they might not be sure about the transparency of the firm, that how much the data and the figures that they are showing, whether they are accurate or not. So that is a challenge, and this is not just in China, but in many other countries as well, especially the countries which face a lot of political turmoil. And yeah, and you also have the risk of getting sanctions and all. Like, so Russian firms are sanctioned, Iranian firms are sanctioned. Who knows which other countries' firms might get sanctioned tomorrow? So those risks are always there. And research has shown that when Chinese firms, especially state-owned enterprises, when they do foreign acquisitions, their corporate governance improves, which means that they get more transparent because now they are present in outside China, so they have to show more figures and better accounting standards and more transparency than they were when they were only in China. But because Chinese acquisitions have not had a stellar record, Chinese acquisitions of foreign firms, so Chinese regulators sometimes hesitate to approve deals, especially if the firm does not have expertise in managing the target business. Then, excuse me. Then third reason is um, cost of new product development. So yeah, the example that I was just telling you, that if Walmart decides to enter airline industry now, if it were to do everything on its own without acquiring an airline firm, then it might take it years to enter the market. Like what happened with Apple when Apple was trying to make its own car. You remember? It wasted billions of dollars, and it took it like 10 years, and still it could not enter the market, right? So, it takes a lot of cost, time, energy, money to come up with a new product and enter a new market. So the better way is, I mean, some companies feel that the better way is to just acquire a firm and enter immediately, right? So that is another reason why uh, why they might do M&A. Then yeah, the same reason spills over to this logic as well. The fourth point as well. The third point spills over to it, that um, you know if you are acquiring a firm, you already know its performance, you already know its past, its results, that how customers have reacted to it. But if you were to do on your own, if you were to come up with your own product, then you have no reference point, you have no you have no idea how customers will react to it. So that is why uh, firms might choose M&A. But the problem with this is that, if for the third point as well as fourth point, that if firms start depending on acquisition as a substitute for internal R&D, then they would stop innovating. They would just start depending on outside firms, that, oh, if we have to do something new, let's just acquire a firm rather than doing in-house R&D. And it would not bode well for them, because one, uh, they would stop thinking in an innovative manner. Secondly, they would start spending money on acquisition. And because they have started spending money on acquisition, they have now even lesser money to spend on R&D, and then the chain continues. So the next time when they will have the next time when they were supposed to do R&D, now they don't have money for that, so they will again go for acquisition, and it will continue, and they would stop spending any money and time on research. Then, of course, diversification. Uh, we have already seen this logic in the previous chapter that firms diversify. So when they diversify, they generally take the M&A route, um, especially if you have to diversify in unrelated diversification. That is, if you are entering a product segment which is not familiar to you, then you cannot develop that product in house. You will have to acquire a firm. And if the diversification is related diversification, then the firms keep getting bigger and bigger. So if you are a firm which has three different businesses, but the businesses are not related to each other, then technically you are three different firms. You just have a common ownership, but you hardly communicate with each other. So you are three small firms which just happen to have a common ownership. You don't have to process data, you don't have to process information with each other. But if the businesses are related, so if you have a phone business, then there is laptop business, and the third is some video game or application business. Take the example of Disney that we saw. If the businesses are related to each other, then it keeps making business more and more complex, because there's a lot of information to process, a lot of synergies to be created. So because you have the zeal to create synergy, so you will have to see all the businesses in a holistic view. So it keeps making business more and more complex and complicated as you keep diversifying. So it's good that it creates synergies, but it can also become difficult to manage, right? So um, diversification is also a reason for firms to acquire other firms. Right. Then, yeah, it's also similar point as the previous ones, that if you want to diversify in a field which you are not familiar with, which is new for you, then to learn new capabilities. So um, I don't know whether you have paid attention to this or not, but a lot of big tech firms, not just tech, a lot of big firms in any sector for that matter, they generally invest a lot in various small startups. Have you seen that trend? So take this example, OpenAI. Which big firm has stakes in OpenAI since beginning? Do you know?
Microsoft and Nvidia.
Yes, yes. Microsoft has like 10% or 10%, I guess, shares in OpenAI since 2017 or 18. And if you guys have watched Silicon Valley, have you watched Silicon Valley on HBO, the sitcom? No, it's
Yeah.
very good. Yeah, yeah, it's a great show. I love it. So, yeah, and that also they have shown that how so many big companies they consistently invest in small startups, be it tech or be it pharma or be it any other sector, because they know that these crazy young guys, these 22-year-old Stanford graduates or dropouts who are working like 20 hours a day in Silicon Valley, they would develop something new which can be path breaking, right? So because they are billion-dollar firms, or even in some cases like about $1 trillion firms, they don't mind investing a few $1 million in those startups if they feel that in the long run they can give them a very high value, a very high return, right? And if that happens, then they can always acquire that firm few years later, right? If they had like 10% or 15% shares initially, and if that gives them one seat on board of directors, and they can have some say in the decision making, and then when that startup blows up 5 years down the line, they can always acquire it, right? And they do that. What did Facebook or Meta did with Instagram and WhatsApp, right? It acquired it, right? So that is another reason why uh, firms do M&As. So yeah, as I told you, success rate of M&As is very low, but still the volume keeps increasing. And later in the end, we will see that how even the biggest and the best firms have done unsuccessful M&As so many times, like multiple times. Right. So, what is what are the problems in achieving success? Why do M&As fail? So the most common problem is integration difficulties. So yeah, you have to like unia meld two or more unique corporate cultures. You have to unionize. Yeah, yeah. You have to unionize uh, different corporate cultures. You have to decide who will have how much say in the decision making of the new firm, right? That is determine the leadership structure and who will fill it for the integrated firm. That is a big bone of contention when M&As happen. Then, of course, inadequate evaluation of target, which we discussed. How to know how much to quote, how much to pay for the target firm. So, who does it? Who does the job of evaluation of targets? Any examples? Who would do this?
Would it
No,
be like a financial institution that's working with a company? They're
Yes,
analysts.
Yes, financial institutions. So, what financial institutions can you think of? What names come to your mind?
Goldman
J-
Sachs.
JP Morgan, Moody's.
Yes, yes. Investment banks, right? Yeah, good examples. Investment banks would do that. So, Deutsche Bank, Goldman Sachs, Morgan Stanley, management consultants. They do that in house as well, but they also go to outside banks who have expertise. Excuse me. Yes. So, yeah. So they do this job. I guess many of you might be working for these banks, I guess, right? Or you would work. How many of you already have jobs, or have job offers or jobs? Yeah, you can raise your hand. I can see all of you. Not many have raised hands. So you're still looking for the jobs. How's the job market, by the way? Not good. Not the best. Yeah, it's horrible. That is what I've heard from everyone. It's horrible. Yeah, so many of you will end up working for these firms. So yeah, this is what you would do. But research has also shown that the performance increases with the number of due diligence related transactions. So rather than doing just one transaction, you should do multiple transactions with the investment bank. That is, cross verify the results, go back and forth many times, but do not make the relationship exclusive with just one particular investment bank. So if you are thinking of doing a big acquisition, give the contract not just to Goldman Sachs, maybe give to Morgan Stanley as well. Have multiple opinions. That would ensure that uh, the step that you are going to take is good enough or is justified. So yeah, as I said, firms are willing to pay a premium price, but the problem is how much premium, because it's just an estimate. Ultimately, you come to know whether the M&A would work only after you work with the firm, you work with the target firm. Only then you would come to know the result. And the third problem is large or extraordinary debt. So firms take a lot of debt to acquire a firm, and that debt can become a very big problem, especially if the acquisition turns out to be unsuccessful. And firms generally used to use, which are less frequently today, but earlier they were more common, called junk bonds. Junk bonds is, you issue some bonds to raise money. The problem with junk bonds was that they do not have collateral attached. Do you understand collateral? Right? Can somebody please define collateral for us?
It's like a backing on an investment. So say you get like a loan from a bank, you can use like your house as collateral. So if you don't pay back the loan,
Right.
the bank then owns your house.
Right, right, right. Guarantee or backing, right? So, uh, security for repayment of a loan in the event of, default. So, they do not have collateral attached. So, that is why their interest rates were very high, and interest rates were also volatile. So, some economists used to think that, oh, if there would be very high debt on the firm, then managers would become more disciplined and they would act more in the shareholders' interest. But that does not happen always, because the managers who are ready to take such high risk decisions may also be reckless sometimes, and they might not actually really care about shareholders or the firm much. They might care more about their job, their compensation. Right? We saw in the previous chapter that sometimes managers undertake acquisitions just to increase, secure their job or increase their compensation. Right? So they might be doing this for their own interests. So this perspective that disciplines managers is not always true. And yeah, managers sometimes like to engage in bidding wars. So you know what happens when you reach that top position, you start getting a lot of media attention. It can also inflate your ego. And some CEOs might feel that, oh, my rival CEO is getting a lot of attention from media because their firm does a lot of M&As. They're always that CEO is always in news. I do not get the same attention. So let me also announce an acquisition. Let me also get some media attention. And, that hubris or that narcissism can also result in, illogical or financially unsound decisions sometimes. So what happens is that firms sometimes or managers sometimes overestimate the synergies. They feel that a lot of synergies would be created if we acquire this firm, and they underestimate the risks or costs attached with the M&A. So synergy would be created when you have assets that are complementary, or if that firm was not acquired by you, if it was acquired by somebody else, or if it had remained independent, it would not have been able to create as much value as it can create under your ownership, right? That is what we call synergy. That most synergy would be created if it comes under your ownership. If it was acquired by somebody else, or if it had remained independent, it would not have been able to create as much value as it can create with you. So that is complementarity, or that is synergy. But as I said, um, firms tend to underestimate costs and overestimate synergy. So what are the costs attached with M&A? A lot of costs attached, lot of transaction costs. So those costs could be direct or indirect. Direct costs are, of course, the legal fees, charges from investment bankers, which can run into millions and millions of dollars. Indirect cost is, it is taking up your time, it is taking up your energy. You can only focus on so many things at one point of time, right? So what we call opportunity cost, right? We have studied opportunity cost in economics 101, something like that. Opportunity cost is basically the cost of the second best alternative that you give up to pursue the action that you are pursuing currently, right? That is opportunity cost, right? So if I decide to teach from 1 to 3 p.m., I'm giving up the opportunity cost of watching a Netflix movie that I could have watched in these 2 hours, right? I mean, that is not the second best alternative, but I'm just giving an example that is what opportunity cost is, right? Uh, so an common term used in economics, right? So indirect costs are those costs, training costs. You need to train those people, the new people, right? So all these costs are involved, and firms tend to underestimate these costs and they overestimate the synergies generally. Then, of course, too much diversification is a problem because it can make the firm difficult to manage, and that is why firms sometimes tend to divest, especially if the M&A is not successful. Then they divest. What is divestment? Divestment is, I mean, we will see it again in the later slides, but divestment is basically selling a part of your business, right? That is divestment, kind of opposite of investment, right? And we saw that acquisitions can become substitutes for innovation. Firms tend to, rather than waiting for the results of their R&Ds, that it would require a lot of time and energy and money to do in-house research. Why not just acquire a firm, right? So that should not happen. It can derail your focus, your firm's focus. You would never innovate then yourself. Then, yeah, that manager's problem, that managers sometimes get a kick, they get that adrenaline rush uh, by engaging in M&As. And if the other top managers do not, point that out in the meetings, if they're not challenged substantially in their decision making, especially by CFO or other board members, then it can result in destructive acquisition. So when those M&As fail, these leaders may blame the failure on others, or on unforeseen circumstances, rather than their excessive involvement in the acquisition process, right? Then um, yeah, the size, because if the firm becomes too large, then there would be more bureaucracy. And we have seen in the previous chapter that smaller firms are able to use Slack better because they are nimble. They do not need a lot of approvals, a lot of long chain of approvals to take decisions. The bigger the firm would be, the more uh, you know rigid your rules will become, the more formalized your structure will become, and it can result in delayed decisions and slow decision making basically, and more complex structure, which would make innovations slow. So that is another problem with M&As. So what are good M&As? What are successful M&As? uh let's see what are successful M&As. One is that you do not pay too high premium. Second is that do not fire too many people from the target firm, because they have worked in that firm and in that sector for a very long time. They're important brains. You do not want to lose those important brains, right? Then acquisition is friendly. So what do we mean by acquisition is friendly? So what happens is that, especially in vertical acquisitions, you know that because you have a relationship with your supplier or distributor for a very long time, say 5 years, 10 years, you already have a trust, you have built a relationship. So sometimes these acquiring firms groom the target firm for several years. We will see this example in the next chapters as well, that you have a relationship with a firm for a very long time. You are grooming them with the objective in mind that a few years down the line, we will acquire this firm. We know this firm well, we have a relationship. So this is our supplier or distributor, and we want to integrate, backward integration or forward integration, and so that the acquisition becomes successful and there are no hiccups in the process. It's better that we first develop a relationship, and that would result in a friendly acquisition. This happens very common. Okay, so acquiring firms tend to groom target firms. Then, of course, we should have a strong complementarities, should not take too much debt. So use your Slack more rather than debt. Um, yeah, don't substitute your R&D for with the acquisitions. Do not replace your R&D. Uh, that is very important for effective acquisitions. And effective acquisition is also when you are able to clear your debt pretty quickly. How you can do that pretty quickly? When you acquire a firm, use its uh, what we call it, unworthy assets, use its loss making assets or loss making entities for sell, like sell those unworthy assets, sell those loss-making assets, and use that money for clearing off your debt. So that is basically restructuring, right? So restructuring is generally used to deal with acquisitions that are not reaching expectations. So if your M&A is not successful, you can sell off, you can divest some of the assets and restructure. You can use that money for clearing your debt, or reaching a financially favorable position. But sometimes you can also do that if there are some changes in the external environment, either legal changes or due to or some structural changes. Some new technology has come up in the market which has made your present assets obsolete or unworthy. So that in that case also you may restructure. How can you restructure? You can do downsizing. Downsizing is basically, um, like for example, the example that I gave, if you have 100 marketing managers, sales managers, and you acquired a firm which had 50 sales managers. Now you have 150 sales managers, but you can do that with your 100 as well. So you might, um, fire those 50 managers. Downsizing is basically decreasing your number of employees or operating units, but it does not change the core structure of your firm. Organizational decline is when you do that unintentionally, when you do not want to drop your employees or operating units, but you are forced to do that because you are not performing well. So that is organizational decline, while downsizing is more intentional, right? So downsizing can be an appropriate strategy if you know if you can do that, if you can do the same task with the less number of people or less number of units, if you have excess capacity, right? So like those 50 sales managers are excess, so in that case you can downsize. While down scoping is you are eliminating business that are unrelated to your core business. So um, what do you think about the Apple closing down its car department? Is it organizational decline or downsizing or downscoping?
Downscope.
Downscoping.
Downscoping, right? Yeah, downscoping. So downscoping automatically includes downsizing, right? But it helps you focus on your core business. So downscoping is frequently used by American firms uh, as compared to other parts of the world, because we have seen that in other parts of the world they like having the firms there have a lot of conglomerates and business groups, diversified, unrelated diversified business groups, right? Which is less common in US. So American firms tend to focus on their core business more. So downscoping is more common in US, but even in other parts of the world, because their institutional environment has also improved a lot in the last few decades. So even they have also been downscoping and divesting to focus on their core business. So in Latin America, these conglomerates are called grupos. In Korea, they are called chaebols. In Japan, they are called kritsu. like Samsung would be a chaebol, right? Then what is another way of restructuring? Leveraged buyouts. Have you heard this term before? Ever came across it? Right. So leveraged buyout is when a party buys all of a firm's assets in order to take the firm private. So it becomes private, which means its stock is no longer traded publicly on stock exchange. Why do parties do this? Why do they undertake leverage buyout? Because they feel that the firm is not performing well, the managers are not performing well, so they buy that firm and they try to restructure it. Restructure how? They may sell some of its assets. They may break it down into two or three forms, two or three smaller forms, right? All those things they do. And why do they do that? So that a few years down the line, they can again take the firm public. That is the objective. That is the ultimate objective. So why do they take the firm private? They so that they can protect against a capricious financial market. They can focus on developing innovations and bringing them to the market. And goal is to sell company back to the market through an IPO. See that? This is the goal. So they feel that if we break the company down into smaller pieces, then they would be able to govern them better. So what are different kinds of buyouts? One is management buyout, one is employee buyout, and one is whole firm buyout. So management buyouts are when the top management of the firm uh, they buy the firm, buy the maximum shares of the firm and take it private. And because top management are the people who know the most about the firm, they know about the things which even employees don't know, which outside market doesn't know. They know about the actual exact position and situation of the firm, so they can take the best decisions. That is why management buyouts are seen to be more successful than employee buyouts and whole firm buyouts. Employee buyouts could be when employee union or something buys out the firm, right? But management buyouts tend to be more successful. And what do these leverage buyouts do? They downscope the firm to the point that it can be sold at a profit within a 5 to 8 year period. That is, within 5 to 8 year period, they again plan to bring back the firm on the stock exchange through IPO. So, what is the comparison between the three restructuring strategies? Downsizing is good, but it may result in loss of human capital. So the 50 sales managers that we are firing, they may be really talented. They may prove to be very good in the long run. And they're also taking the knowledge with them to a rival firm. So while yes, it saves us costs because we don't need 150 sales managers, but it is still a loss of human capital, right? It is still loss of human capital, which we may want to avoid. Downscoping is good because it reduces debt, helps us focus on our core business. Leverage buyout has higher risk and higher debt cost. you may need to take a lot of debt to buy a firm, to buy all the shares of the firm, right? So loss of human capital is potential problem of downsizing. So in general, downsizing may be good in a short, we remember the tactical versus strategic terms from previous chapters, right? Tactical action and strategic action. So it may be good for short term value, but not for long term value. Downscoping is, it has more positive outcomes in both short term and long term. LBOs are good, but they are more risky and they result in a lot of debt. It was seen in 1990s as well, when a lot of firms, uh, you know, they were LBOs, but they had to file for bankruptcy because they could not become successful in their objective of restructuring the firm and taking it back again to public through IPO. So uh, they were unsuccessful, and also because your objective is short term, like within 5 to 8, like you have to quickly go back to public. So it may also result in short term focus and risk averse managerial focus. So because you can be myopic, you can be short sighted. So that is why you may not invest adequately in R&D and other major decisions. And because it requires a lot of debt, so it should be done mostly in mature industries where you have a lot of stable cash flow, and no you have some slack, you do not have to take a lot of debt basically. So you see, we already know that Kmart has filed for bankruptcy, it failed. HP resulted in failed M&A. So many big firms, so many successful firms, like even Google has suffered failed acquisitions. Viacom has suffered failed acquisitions. So many, you would see them, and still these firms keep doing M&As every year, because even one out of 10 becomes successful, then it can give you a lot of value in the long run. Right. What do you feel about M&As? Okay, so this was chapter 7, and we have international strategy tomorrow, which again is very interesting. And then cooperative and CSR we will cover the same day on January 12th. I've already uploaded Walmart and Amazon questions, and you guys should start deciding on your final form and start working on it. Only two groups have finalized their firms here, Group 1 and Group 2, AMC and Netflix. I would recommend that. Do not leave it for the last moment. It can, accumulate into a lot of work. So you should finalize your form within a day or two and start working on it. Basically, what you have to do is just use all the strategies that we will learn in this semester, like um, the firm's international strategy, the firm's corporate strategy, the firm's CSR strategy, the firm's M&A strategy. You basically have to use and apply all the strategies of that firm analyze it, present it before everyone, and then in the end, just give a short recommendation. What do you feel the firm should do? What is its present standing and what it should do for the future? That is what the final presentation is about.